Good evening, everybody. Greg McDermott with Cyber Trading University, welcoming you to our free options FBC Delta and the Black-Scholes model. I appreciate everybody joining us this evening. Someone just asked a question, and we are going to be recording this, and it will be made available to you. If you got to jump out, I know 7 o'clock p.m. Eastern time could be a little tough. We're glad everyone's with us tonight, and wanted to give you a heads up. At the end of the presentation, we're going to talk to you about one of the offers that we have, and it's going to center around our cyber trading group. But in addition, it'll give you access to what we like to call our options trader talk. I do it Tuesday and Thursday nights, 8 p.m., 8 to 9, much more of an open forum dialogue between myself and the students that are welcomed from cyber group. So we are going to be doing that tonight following this presentation at 8 o'clock. So let's get through the required elements. Here's the CTU risk disclaimer. Take a moment to read that. And about Cyber Trading University, CTU has been an educational trading institution since 1995. Cyber Trading University established itself as a leader, first by working directly with the SOES trading firms, teaching them to day trade. CTU was one of the first to establish itself as a quality stock market trading school. Each instructor, including myself, has a minimum of 6 years of actual trading experience before they begin to work with students. Over the past 14 years, we've taught thousands of students to be successful and profitable traders. The CTU headquarters are located in the heart of the trading world in New York. As I always say, my mother's favorite slide, that's me. Earned my master's degree of applied finance from Macquarie University in Sydney, Australia in '89. BS in financial management from St. Joseph's University in 1987. I was a crude oil options trader at the New York Mercantile Exchange. I was the head options market maker for JAS Securities at the Philadelphia Stock Exchange. And while I was there, I managed our firm's portfolio risk for our team of 10 options floor traders, all of whom I hired. I was a market maker in the Dell computer crowd at the Forex, which today doesn't sound too impressive, but back then, Dell was the busiest equity option traded in the United States. I also directed an off-floor trading unit for JAS, and while I was there, I qualified as a DTR for the ICE, the ISE, the International Securities Exchange. So, as I said, my mother's favorite slide, probably my least favorite slide. We're going to talk about the Black-Scholes model and the values that come from it, and we're going to focus mainly tonight. I'm going to take a really in-depth look at Delta. But to set the stage, let's talk about what is the Black-Scholes model. And to be clear, the Black-Scholes model, originally developed by Fisher Black and Myron Scholes, was introduced in their 1973 paper, The Pricing of Options and Corporate Liabilities. The model originally was used to determine a way to hedge the options using a ratio of underlying securities. What's that mean? They were trying to figure out a way, if we own options in IBM, is there a way to hedge that position, maybe mitigate some risk, lock in some profits? And that's where the model came from. Now, today, there are a myriad of options pricing models out there. All began with the Black-Scholes model, and because of some of the limitations, which we'll talk about, models have been improved and updated, and just the simple ability, the computing horsepower. Imagine, I'm sure that the computers that Fisher Black and Myron Scholes were using back in 1973 had significantly less computing power than the smartphone each of you could be holding in your hand right now. So, there were some limitations, but the general concept, the general layout, gave us the trading operations that we have today. In particular, we're going to talk about the values that come from the model, and we're going to focus mainly tonight on Delta. So the assumptions, which have led to improvements in the models, clearly give us some assumptions that can be a little difficult to work around. For example, we assume in the traditional Black-Scholes model that there is European exercise of your options. What's European exercise? It means that the options can only be exercised at expiration. There is no early exercise. Well, in the equity options that we all trade today, they're all American exercise, which means you can exercise your right if you're the owner of a call or a put anytime up to and including expiration, but you can exercise early. So early exercise is now part of the landscape. They also assume that the risk-free rate and volatility remain constant. Now, considering that prime has been at what, 3.25% here in the US since December of 2008, you almost could live with a risk-free rate being static. But volatility remaining constant is a bit problematic for the original model, which is why the subsequent models have worked on that. Volatility moves almost, instantly, probably a little too extreme, but trade by trade volatility in an option series can change. Stocks pay no dividends. There's clearly a problem with that one. And then markets are efficient. Anyone who wants to take a chuckle and laugh at the fact that they believe markets are efficient, you're more than welcome to do that. That's a whole debate for another day. But let's just say that based on that assumption, it helped the Black-Scholes model come into existence. Now, for those of you that want to revert back to the old Saturday Night Live joke with President Bush, I thought there was going to be no math on this test. We will not be quizzing you, but I just wanted to show you that although this model looks relatively complicated, the majority of the inputs are easily defined. For example, if we look at T, the time to maturity, let's do that again. T, the time to maturity. We know how many days there are to expiration. We know what the underlying spot price is. We know what the strike price is, and we know whether it's a call or a put. We've told that the risk-free rate relatively static. So the cumulative distribution function of the normal distribution, not an overly burdensome calculation. And then this is the one, the volatility, that is the biggest wild card, the most difficult to sort of predict and gauge. So why I'm showing you this is that it really does allow you to see that it's not that difficult to figure out this model. I'll grant you that it is kind of high math. I remember way back in the day trying to program it into my old HP 12C calculator, unsuccessfully, I will add. But the majority of the inputs are relatively simple to define and static. So to me, it all comes down to really understanding each of these inputs, but also the resulting values, gamma, delta, vega, theta, and rho. We're going to focus on delta, and understanding the importance that volatility plays in those. So those options that we talked about, the options Greek, gamma, vega, theta, delta, and rho. You've probably all heard about options Greeks. We could teach a couple hours on each of those if we wanted to get into the weeds of how they can impact your options trading. But we've got a short time tonight, so we're going to focus on delta, but I don't want to leave out the others. So let's talk about what is vega. Vega is the measure of the effective change in volatility on the price of an option. So that calculation that we talked about that can be difficult to determine and can move and is very fluid is measured by vega. You normally will talk about being long vega or short vega. Do we have everybody got me, got volume okay? Somebody's telling me we're getting a little bit of a volume problem. Can somebody give me another heads up that we've got we're okay on volume? Okay, thanks, Tracy. So the measure of change in volatility, that's what we're going to measure. We always talk about vega being either long or short Vega. Effectively, if you are long Vega, you are the owner in general, the owner of options. Now, if you have a portfolio of options, you could be long and short, and depending on the ones that you own, you could be long or short volatility when owning the exact same amount of options that you're short. But in general, when you buy an option, you own volatility, all things being equal. And you can also use this to be a measure for your portfolio. So you can have volatility be a cumulative function. I'm not sure why I would be having problems with the mic. So you can take the volatility across your calls and puts, across your months and strikes, and aggregate them to get a net position, whether you are net long or net short Vega or volatility. And the way we measure that, again, from the options pricing model is Vega. I will double check. Check the mic again. Trying to play with the volume to give you guys a little bit better. I think that's about as good as I can go. So Vega is volatility. Theta is the measure of the effect of the passage of time on options pricing. You'll hear traders call that time decay. And when I say here that it's always negative, what I mean by that is that an options value is going to be less tomorrow than it is today, all things equal, simply because the passage of time. So options are a decaying derivative. And when you own an option, Theta works against you in time decay. So you always want to make sure that you understand that when you own options, you are long Theta, but that Theta is working against you on a daily basis. So you end up having the idea of sort of a sand through the hourglass, where you're having the options are worth less tomorrow than they are today. We measure Theta, although I always say it's negative. If you are short options or short Theta, the passage of time works to your advantage. If you sell the options and you're net short, and again, this can also be aggregated, you can have a position where the passage of time is to your advantage. So Theta measures the effect of the passage of time on your prices. Most important thing to remember here is, again, that when you own options, again, you own Theta. So when you buy a call, what do you get with that? Well, you own volatility and you own Theta. So the options are decaying and the volatility could be moving. So how can a passage of time but an increase in volatility negate each other, at least temporarily, when it comes to ultimately the price of your option? Because that's what it all comes down to. The options pricing model gives us a value of our option, and that's what we need to concentrate on. All of these inputs and all of these measures work to give us values, but they are two sides of a coin. Again, when you own an option, you're long Theta. When you're short an option, you're short Theta. When you're long an option, you're long volatility. When you're short an option, you're short volatility. Rho is not that girl named Rosemary you went to high school with. Rho is the measure of the effect of interest rate movement on the price of an option. So although interest rates have not moved for a significant number of years, when and if they begin to move, the impact of that underlying will be measured by Rho. Rates are normally deliberate, and as I noted there, day-to-day normally not a big deal. But where it comes in, remember, you are, let's say you're long options. You may be in the Black-Scholes model, you can be at risk for interest rate movement, and there gets to be a time when interest rates move up. I can remember when they were much higher than they are now, where it was advantageous to hold options positions rather than stock positions, because as some of you know, a lot of times stock can be bought on margin. That margin value is based on interest rate, and if interest rates are higher, it costs you more to own the stock on margin, thereby making the value of, say, for example, calls more attractive because as an alternative to owning stock. So we're not going to get too deep into row, but it is another measure. When you own options, you are at risk for interest rates going up when you're short going down. And it can be important to leaps. Yes, row can be. Again, it's not as important as the other ones, but it is a measure, Donna, and it can. And someone says, oh, it wants to buy falling volatility. Well, as a generic statement, buying lower volatility usually is a good idea, but trying to jump in just because it's low. We've talked about it. We did some of the trades last week in the options trader talk. We did a couple of earnings plays, and one of it had to do with the volatility was relatively low, thereby making the absolute dollar value of our options pretty cheap. And in a situation where I may have been normally a seller of a certain spread, we were buyers, and that had to do with the fact that volatility was relatively low, thereby it affecting the output or the price value of our options and making it, to me, more of a logical trade to buy the options because of low volatility than to sell. So we're going to talk about delta now, and we're going to there's a lot to cover. So let's talk about, first and foremost, and I'm going to use the pen again, deltas range between 0 and 100. And we usually look at them, if you're talking about calls, you're usually positive or long deltas, and the deltas of puts are usually negative or short. Let's talk about that for one moment. There's a terminology people get a little confused with. They'll hear me or another trader talk about being long and being short, and there's two different ways to define long and short. One is the simple ownership. If I buy anything in the options in the trading world, if I buy anything, I will say that I am long that underlying, whether it's a call, a put, a stock, a future, a bond, I'm long it. If I've sold it, I will say that I'm short it. I've shorted the stock, I shorted the call, I shorted the put, I shorted the bond. But the other way to think about it is my directional bias. And that has to do with long, my directional bias is profit to the upside. Short, my directional bias to profit is to the downside. So in theory, I can be long and be short at exactly the same time. I can be long a put, which would make me long, I own the put, but short, my directional bias to profit by owning a put without any other position is profit to the downside, or short. So I can be long and be short at the same time. So as I go through this, I don't want to lose anybody on that sort of turn of a phrase that may be confusing. So when I'm talking, normally I'm talking here, I'm talking about directionally long or short. But you can also mean just from simple ownership. And the deltas help us define the characteristics of options, and we will call them in the money ITM, at the money ATM, or out of the money OTM. And pretty simple. And at the money, will normally have a delta of about 50. Remember, we told you they go from 0 to 100. And in the money will probably have, depending on the time till expiration, 65 delta or so. And an out of the money will probably have, the same 35 delta or lower. And one of the other things you need to understand is that the absolute value of the calls and the puts on the same line are going to equal 0. What's that mean? That means that if on any particular line, if my calls are a 70 delta, my puts will be approximately a 30 delta. Now, as we said, this is really kind of a positive 30, pardon me, a positive 70 and a negative 30, but we're talking about the absolute value of those. So when you know that the calls are a 70 delta, you can be relatively confident that the puts corresponding month and strike will be approximately 30 deltas. The two together will equal 100 delta. Now here's a screenshot of Think or Swim, a bit of an eye chart for everyone, and I apologize for those of you, including me, who are looking at this like, all right. But what I want to show you here is, and I'm going to try to use the highlighter, normally unsuccessfully, but I'm feeling lucky tonight. So let's see. Now, this is, of course, everyone's favorite stock, Apple. And at the time, Apple was trading at, right here, just about 119. So that made this strike, again, these are February, this made this line here in the middle, the 119 strike, our at the money strike. And what you'll notice is, here's our value. There's delta. We'll talk about gamma. Here's theta. There's vega. And again, the same for delta. I'll skip gamma. We'll talk about it, though. Theta and vega. A couple things we want to point out here. That as we said, on this line, here's the delta. Sorry. There's the delta for the 119 calls. Here's the delta for the 119 puts. 50 and 50. So I was telling the truth, absolute value 100. If you look at, say, the 114 calls right up here, they have a 79, and the puts a 20. There's my approximately 100. I told you it isn't always exact. It's going to be a rounding error type thing. What you'll also notice, though, is with our at the monies, our theta is 8 cents in decay and about, again, 8 or 9 cents. They're approximately going to be the same. If we go to that 114 line, theta is 7 cents, theta is 7 cents. You go to the 124 line, theta is 5 cents, theta is 5 cents. So we lose. What does that mean to you and to me? Well, it means that all things equal, your options will be worth 5 cents less than they are today, in that case, if everything else remains the same. The value of the option will just drop by 5 cents. And Vega is similar. Vega here, 9 cents at the money, 9 cents at the money in the puts. 6 cents out of the money, 6 cents out of the money. 6 cents out of the money, 6 cents out of the money. What does that tell you? That tells you that if the volatility increases, we'll use the term click because that's what you'll hear a trader say. Volatility increases by 1 click, the price of your option will increase by 6 cents. If your options decrease by 1 click, the option price should be reduced by 6 cents. Now, with the advent of the computers that we have today, for retail traders and traders on the floor, doing these calculations, not a big deal. But, as my father used to tell me the stories about how, he used to have to walk, uphill both ways to school in the snow, carrying a half a ton of bricks. You've all heard those stories. I'll tell you one of my own. When I traded on the floor, so many years ago, we didn't even have a printer or a computer in our office at the Philly Stock Exchange. I would print when we first started. in 93, I would print my trading sheets on paper, and then I would print a big range, hoping that the stock wouldn't trade outside of that range. And any change in volatility, like I just showed you, nowadays you just modify the volatility and all your options values will change. Well, back then it was, okay, vol's up 3 clicks, so I'm going to have to change the price of my options by 18 cents and just keep that in the back of your head as you're pricing everything else. So a little bit more hands-on. But if you look at the trading screen now here from Thinkorswim, all of these values are laid out for you, delta, gamma, vega, theta, and you can check how they may impact you. Also, when you put a trade into your position, it will allow you to see the individual inputs and the cumulative of your position, which we'll see later tonight when we're talking in the Options Trader Talk. So there are really 3 ways to think about delta if you're a trader. What are some considerations for trading skew? That's probably a little bit, I'm not exactly sure, Vadim, what the question. You can try to trade option skew when you have calls and or puts that are skewed out, or when your out of the monies are skewed higher, taking advantage of that and possibly trading vertical spreads. But that's more of a detailed question. If you want to come back and you're going to be in the cyber group, I'd be happy to try to spend a little more time and show you live in Thinkorswim what that is. But the 3 ways to look at delta, one is simply in the black and white context of the Black-Scholes model, the rate of change of the price of your option. How much will the price of your option change based on the movement of the underlying, in this case, underlying stock? So if your underlying, if you have a 50 delta option and your underlying stock goes up $1, you would anticipate that you would get approximately a 50 cent increase in the price of that option. It doesn't matter what the price of the option starts, where it starts. If the delta is 50 and the underlying stock goes up $1, you would anticipate the price of the stock, the price of the option to go up 50 cents. So if it's a $20 stock and you've got a 50 delta option, or it's an $800 stock and a 50 delta option, a $1 move in the underlying would equate to approximately a 50-cent move. So this is the strict definition of the rate of change of your price of the price of your option based on movement of the underlying stock. So that's one way to look at it. How much is my value going to change up or down based on the movement of my stock? So in this example, we have, get my pen out, we have a stock price of 100. Oops, I need the pen, not this. I have a stock price of 100. I have a delta of 50, and I'm at the 100 calls. So if it goes up $1, I would anticipate these $5 calls to be worth $5.50. I'd anticipate these 20 delta calls, the 110s, from $2 to be worth $2.20. And these in the money 80 calls, they're $11, would be worth $11.80. And the same is true on the downside. These would now be worth approximately $10.20, $4.50. Make this a little bit better, a little easier to read. And then these would go down 80 cents to $1.80. Obviously, drawing is not my strong suit. So that shows you, based on simply the rate of change, what the option price should be after $1 move up and a dollar move down. And the other way to look at it goes back to the original question that Black-Scholes tried to address. How do we hedge our underlying position? And the way to think of delta, you think of it as stock when you're talking about equity options. So if I'm long 100 deltas, it's the equivalent of being long 100 shares of stock. If I'm short 100 deltas, it's as if I were saying I'm short 100 shares of stock. And what you do with that is, in order to hedge, if you choose, would be to do an opposite trade in stock to take you to a point where we would call it delta neutral. What is delta neutral? It would be if I was long 100 shares of 100 delta or 100 shares of stock, if I sell 100 shares of stock, I then have a position that is delta neutral. I've taken my, we'll call it synthetic or hedged ratio 100 deltas of stock, sold 100 actual shares of stock against it, and locked down my trade for that moment. So it's a way to hedge your position, and in addition, you can do that by aggregating all of the deltas within a portfolio. So if, again, when I was a trader in Dell, I would be long and short, calls and puts, at the money, in the money, out of the money, front month, back months, and leaps. Then you can aggregate the delta and come up with a hedge for your portfolio at that moment in time. But know that it is a dynamic calculation. So when the underlying moves, as you'd imagine, the delta is going to move with it. If you are long deltas and you're long gamma, which we're going to talk about in a moment, as the stock goes up, you get longer, which allows you to sell more stock. And as the stock goes down, you would get short and allows you to buy stock. So one of the ways to look at it. So this is the second way to look at it. It's the hedge ratio. How can I put myself in a safe or hedged position using stock and the stock equivalent derived from the options pricing model with my options? And here's just a quick graph that shows you as your long, in this case, options, as you go get longer and longer deltas, you have stock to sell, that's the green. And as you get shorter and shorter deltas, you have stock to buy to get yourself back to delta neutral. So if you were long some puts and let's say the stock moves down to this level, well, now I'm short 4,000 deltas, so I would buy 4,000 shares of stock, and I could then have a position that would be delta neutral. As the stock, let's say the stock rallies and goes back up to, say, from 46 to 50, and let's say I did nothing. Well, I'm now should be delta neutral, but I'm long 4,000 shares of stock, so what can I do here? Sell 4,000 shares of stock. I'm delta neutral again, but I just made 4,000. I just made from 46 to 50, $4 on 4,000 shares of stock, or $16,000. Oh, if it were just that easy. Clearly an example, but you get the idea. And the way that this is determined and the way that this is implemented is when you use gamma. So how would you hedge? Here's an example. For whatever reason, if your position, if you were long puts, the stock went down and you were long, 10, let me think, you're long, let's say you're long 140 delta puts. So you're short 4,000, that's the example we just did. So you would buy 4,000 shares of stock, you'd be delta neutral. Stock goes from 46 to 50. You'd end up being, your position, the deltas from your options would disappear, and then the delta you'd be left with is the stock, and then you would make it. So again, extreme example, trust me, really hard to hold 4,000 shares of stock for $4. But That's the way that it works in its general sense. Let's take a look at the other way to look at delta is at any point when you're trading an individual option as an approximation for the percentage chance that your options will close or expire in the money. What's an in-the-money option? An in-the-money option is one where there is intrinsic value at expiration. So for a call, the call strike is below where the underlying is trading. So the 45 calls are in the money if the stock is trading at 48. For puts, the 50 puts are in the money with the stock trading 48. So in general, it's an approximation that tells you what are the approximate chances that your option will finish in the money at expiration. So if you look at this, I've got as my example, again, it's the exact same one we were looking at before. We're sitting back here on this 119s, okay? That's where we're looking. So our delta is 50, and then if you notice here, this column is probability they'll end in the money. 48 point, I crossed it off. Sorry, that doesn't help you. Let me erase that. 48.16. If you look at the delta here, we've got a 70 delta and 67.72% chance that it finishes in the money. We've got a delta over here of 30 in the puts and approximately 31.85% chance. Now again, this is, quick and dirty trader math on this one. It's not absolute, but it's in general. You got about two out of 3 chance if you buy the 116 calls that they're going to settle in the money. So that's the third way to look at it, as an approximation. What are the chances that the options that I'm buying are going to finish in the money, thereby making them profitable for me? So that's another way to look at it. And here is just a quick look. We mentioned volatility, but this graphically shows you, and again, we're talking about the 50, the stock at 50. So with low volatility, the deltas for a 65 call, these are call deltas, are relatively low. Let me show you where I am. These are the 65 delta calls, and our volatility, with low volatility, our delta is about 0. But with a higher volatility, you've got about a 5 delta. But as you get closer to at the money, which is 55, you end up getting this delta at 60 is 13, where it's only 1 delta. So the higher the volatility over here, the more it will impact the value of our options and thereby the delta. Well, why is that? In just a simple math, regardless of what this says here, like regardless of these numbers, just a logical look at it. Let's think about it just from a simple standpoint. What do we need? We ultimately want our options to finish in the money, right? That's the objective. We want our options in the money so we make money. If volatility is higher, what are we talking about with volatility? We're talking about the movement of the underlying. In general, volatility is quoted in annualized terms. So if we have a stock that has a 45 volatility, we would expect in a year to see that price move up or down 45% within a year. So if you have a $100 stock, you would expect it that it could trade as low as 55 as high as 145 with about a confidence level of about 67%, the old normal distribution. So that's what we would expect at 45. But if our volatility is 15, with that same confidence level, we would expect the stock to trade between about 85 and 115 with about a 67% confidence. So you can see when the volatility goes up, there's a better chance statistically that our stock could move high enough that our out-of-the-money calls in this example could go in the money. So that's the idea. The higher the volatility, the greater the chance the range will get wide enough that our options will finish in the money. Lower volatility, lower chance to get in general. That doesn't mean it can't happen, but from where we sit today, less likely that it will happen that you'll get that move to a higher or lower price based on a lower volatility. So again, it just logically, a higher volatility gives us a better chance that we get a big move up or a big move down, so our out-of-the-money calls or our out-of-the-money puts could become in the money. If our vol is very small, then our price range is going to stay small, and these options out of here are really worthless, which is why we value them in this example. Again, these are calls. Why we value them at almost like zero. So that's the simple idea of why volatility or how volatility impacts the price of these options. And here it is for the puts. It's the same, just the same idea, just a different chart. These are put vols, and sorry, let's go backwards. Oh wait, I'm losing control. Grab them back. I'm jumping slides here. So those are put vols, the exact same. I'm not going to waste your time on that. It's the exact opposite theory. Same theory for puts versus calls. That our out-of-the-money puts here are worth less when the vol's low. We have a chance to get some value out of them when the volatility goes higher. And the next one is time. Not surprising. It's the same idea. What is our objective? Our objective is to get our options in the money. The more factors that allow us to get them in the money, the more value we bring to the options, whether it be their price or their delta. So if there are 3 months to go, in this example, let's take the 60 calls. They're worth about 3. But now I've got 6 months. I got twice as much time. Well, now they're worth about 12. If I take it out to a year, it jumps to 25. Why? I've got more time to get my options in the money. And that's how it's affected, the price. And it goes the same way for the puts as you would expect. And one of the other things you'll see, this is called Troublefication. And I'm sure Donald Trump will be sad to hear this, but it has nothing, it's the only word I can think of that has Trump in it that doesn't have anything to do with him. What it has to do with is the shape of this graph. And what it shows you is that as you get farther and farther out here, away from expiration, the deltas of options in general tend to move a little closer and stay towards the middle, stay away from the absolutes. But as time passes and we get closer and closer, our options delta, the puts, tend to go towards 100 or minus 100 or 0, and our calls tend to go towards 0. We tend to go to the extremes. Why is that? Because with 1 day left till expiration, most of the options are either already 100 in the money calls or negative 100 in the money puts, or they're 0 out of the money puts. Why? Because you only got a day left. So the number of options that have a delta other than 0 or 100 a day before expiration are very few, and it all depends on the volatility. But as you get closer and closer and closer to expiration, as time moves away, you move towards 100 or negative 100, or you go to 0. And if you look at time decay just simply as a chart, options decay like this, and then as you come towards expiration, they fall off the cliff. The time decay kicks in significantly. Now, the last, and I sort of touched on it, just sort of touched on it a little bit, is the last option group, gamma. And what gamma gives us is the rate of change of the rate of change. So it gives us, it's a measure of the velocity of price change and the hedge ratio. Okay, Greg, what's that in English? It tells us how much is my delta going to change. Remember I told you before that if you had an option and it was a 50 delta and the underlying stock went up $1, your calls would go up by 50 cents. Well, the truth is gamma says that you're probably going to really go up by maybe 53 cents. You know, if you're a stock that has a high volatility, you could go up to 58 cents with a dollar move. If you have a low volatility, you might only go up to 52 cents. Volatility, again, impacts the gamma number as we calculate all of these. So the gamma measures how much is our delta going to change. And as you get closer and closer, by the way, gamma is if you own options, you are long gamma. If you are short options, you are short gamma. And if you're short gamma, you're probably going to lose your appetite. Your hair may fall out. Your hair will turn gray if it stays in, and you'll have sleepless nights because trading negative gamma, take it from a guy who's done it, will do all those horrible things for you. It'll make you miserable because I've had to do it. So again, gamma is that fifth measure of the rate of change of delta. Now, I want to thank everybody for joining us this evening, and I want to point out at the bottom left on your screen, there's a box. I'm going to click it myself to see whether it does what it's supposed to do. It's going to open up a window for you that's going to allow you a $29 offer for 5 days in our cyber group. Anybody on the call who's been in the cyber group knows that is a day trading room. Our screens are up all day long. There's commentary during the day by Fausto and Rich. It shows you when we're getting in. It shows you when we're getting out. For $29, you get to look for 5 days. Don't take a guess as to how good we are at the day trading. Go watch for 5 days for $29. And the added bonus is you get to join us in the cyber group. In fact, if you join tonight before 8 o'clock, I'll be in there at 8 o'clock in our cyber group options trader talk. I'm sure Tracy will be there with me for sure. She always is. And we're going to talk about options. If you've got an options trade you want to talk about, you have an earnings you want to say, geez, how do we trade this earnings, Greg? Or, hey, tell me a little bit more about option skew. One of our friends asked us about that. Any of those questions, it's a much more open forum, free form to talk about anything you want for options. We do it twice a week, Tuesday and Thursday nights, 8 p.m. We put positions on. We talk about positions that we have. We put positions on that you want to. It's not just me telling you, do this, do this. And one of the advantages is you get to hear somebody who's done this for a living walk through the thought process of, geez, why would I do this trade over that trade? Why would this be a good idea over that? And you can kind of see the thought process and the methodology. And I think that's a big advantage. So if you look at the bottom left, all you need to do is click on your link for the 1 week live trial for the trading room. You can join the team for 5 days, watch them screens up. Fausto talks twice a day. The screens are up from about 8:30 till 4. And I'm telling you, there's people on here who could tell you how much money they are making. I'm not at liberty to, but there are plenty of people from our cyber group on tonight who are making money every day trading. So, and as an added bonus, you get to come to our options trader talk for the next couple of nights. We'll do it tonight. We'll do it Thursday night. I hope everybody can join us. This is Greg McDermott for Cyber Trading University signing off. Everybody have a great night.